Life insurance companies do not like our industry because, God forbid, if they sell a policy successfully in our marketplace, they will be paying a claim. We talked about 98% don't go. There's no depth deep enough to explain to you the greed involved in the life insurance industry. They do not want anybody to succeed when they can avoid it. A consumer will receive 6.6 times more settlement value than they will surrender value.
And as we go into this economic slowdown, I will tell you the one thing I'm seeing is a higher and higher surrender rate, which means people are surrendering their policies because they just throw their arms up. They feel, all right, well, things got rough. My real estate ventures didn't go good. I don't have the money, so I'm just going to let this thing go. What's going on, everybody? Chris Naugle back with the Money School podcast. This podcast is all about taking back control of your money. And you can do that by learning how to be your own bank. And that involves a whole bunch of educating, but also you figuring out what your needs and goals are. So in today's episode, I've got an amazing guest. This is his second time on the podcast. We're going to go deeper into the life insurance industry. Now, before I introduce our guest, I just want to point out a couple of facts. Life insurance companies win when the client cancels their policy, when the client lapses their policy. And life insurance companies, 98+% of the time, win when people buy term insurance. Have you ever thought about that? Probably not. The reason for the win for the life insurance industry is because term insurance is, I'm not going to say a fixed game, but they've got it figured out so that less than 2%. You heard me correct. Less than 2% of all term insurance policies will ever pay a death benefit to the widows or the spouses that are left because they know, the actuaries know, we're not going to die within that time frame. But the same can be said for lots of products that are being sold in the marketplace today. And these are the things that my guest, Rob, and myself are going to be talking about, because in today's world, there's products, all sorts of fancy products called indexed universal life. You got variable universal lives. And you know what? I've seen the writing on the wall for these, because it's no different than back in the day with the Target UL policies and all these other policies. These products are created to benefit the life insurance companies. And how do the life insurance companies win? Well, they win when you don't. And that's what we're going to talk about. We're going to talk about how you can change the game so that you win. That's right. You, the insured, wins. So Rob, you've been in this industry a long time. Can you just give my audience a little insight of who you are, what you do, and then let's go into this world of life insurance and how people can turn the tides in their favor.
Well, thank you, Chris. Again, my name is Rob Haney. I own the Life Insurance Settlements, Inc., which is a broker. We're based out of South Florida. 31 years ago, closing on 32 years ago, we began this journey. And it was to help people at the time sell their life insurance policies when they had a terminal and or chronic illness. So HIV and AIDS would come to mind is really how this business began. Around the turn of the century, funny to say that, but true, it morphed into the life settlement business. And in so much as it morphed, it expanded, it lengthened its reach. It helps people who are in their 60s and up sell their life insurance policy that they no longer want, they no longer need, or can no longer afford. And, our biggest obstacle, if you will, this is just the lack of awareness. Fortunately, it's shows like yours and others that talk about everything, including life settlements, that help people understand that they own their life insurance policy, just like they own their house. You can sell your house, you can sell your policy. So we're here to help people get the most money they can in a competitive marketplace for the life insurance, and then use those monies for what they see fit, what they really need it for today. The reason they bought the life insurance policy, all the reasons associated with that have come and gone. And now it's what is important to them. Long-term care comes to mind, annuities, income, for example. How can they fund their retirement with proceeds out of a policy that they didn't know they could sell prior to this conversation?
Well, I want to start with, the product we all know so well, we hear about it the most because the life insurance companies spend the most amount of money advertising it. And it makes perfect sense when people understand why that is. And also, there are companies that literally that's all they sell. And this product, folks, is called term insurance. It's a perfect way to rent protection on your life for a period of time. So let me give you an example. I own a lot of term insurance, and I own term insurance for a specific time frame. So for example, I have real estate that we own in our portfolio, and those real estate properties all usually have a mortgage on them.
Correct.
20, 25, 30-year mortgage. So I will buy a 30-year term policy to protect the risk if I died prematurely that my family doesn't have to inherit a mortgage on one of our rentals. That's a really good use for term insurance. Car loans, student loans, all sorts of things. You see, they have a definite time frame that you're protecting. But you see, there's a lot of companies out there, I guess what the heck, this is my podcast, Primerica, makes the point that buy term, invest the difference is the greatest thing you could ever possibly do. You can never lose. Well, they are wrong. And I will battle with any Primerica agent that comes out and says that, because you know what? The stats don't lie. You can't buy a term policy and expect that term policy to protect you for your whole life. They are not designed to do that. The insurance company wins 98% of the time because you don't die. And hey, good for you for not dying. But because you didn't die, you paid all these premiums, which I'm sure the agent told you, oh, this is the cheapest way. This is the most cost-effective way. Why pay that expensive whole life premium when you can buy a term and pay the least amount? Folks, if you know how to do math, you will figure out very quickly that term insurance is indeed the most expensive life insurance you'll ever buy, because 98% of the time plus it will not pay out. So what did you pay for? Well, you paid for protection, and that's all you got. And then they'll spin it and say, oh, invest in the stock market and you'll have more money here. Well, people don't keep the money in the stock market. They don't keep their money in those mutual funds. They spend it and they end up with nothing, not even enough to pay for a burial. I've seen it too many times, and I'm here to put my foot down and tell people that is not what should be in your planning. And Rob, now I know you deal with term insurance a lot. You guys even buy term insurance policies, I should say convertible term insurance policies. So talk to me a little bit about why the industry has literally made term insurance the kingpin for life insurance and what everybody should be buying.
Well, I don't know why they. It's just because it seems that it's cheaper. It appears cheaper because they always sell you on the fact that you're just buying the insurance. The pure cost of insurance is the pitch, right? You're just paying. That's it. You're not paying the extra money. You're not building cash value. You're not building surrender value. All the different terms that you're associated with that. And you're right. Primerica will tell you and invest the rest in something else, and you'll do better. The bottom line is that as we approach it is, term policies that can be converted, as you mentioned in the segue, was that enables a buyer in my business to be able to turn the policy into a permanent product. And in doing so, there's a commission that's generated from that sale. I mean, from that conversion from the term to the whole life or the universal life. And that conversion premium sometimes is just enough to manufacture an offer. And the offer could be low, could be someone in their 60s, there's nothing wrong with them. They're throwing the policy out. They're not converting it. They're not renewing it. So they're going to get nothing, as you alluded to. So now they're going to get $10,000, $20,000. And you say, well, who's going to sell $1 million life insurance policy for $10,000 or $20,000? And I said, the individual that's about to throw it in the garbage for nothing. That's who's going to sell it. So that's the low end, the extremely low end. Other people can sell a term that's not convertible if they, God forbid, have an unfortunate health situation. So there's ways that can be sold. They can renew those terms. But interesting things happened lately is the ACLI has come up with an idea in a case before Supreme Court in a part of the country. Well, it doesn't matter where it is, but the reality is they're trying to pretend that now if you do a conversion from a term to a permanent product for the means of the settlement, which you may or may not even know you're even doing, right? That somehow is back to their old term stoli, that this is now a manufactured policy specifically for the sale in the life settlement market. As you know, and many maybe listeners don't know, the life insurance companies do not like our industry because, God forbid, if they sell a policy successfully in our marketplace, they will be paying a claim. You talked about 98% don't go. There's no depth deep enough to explain to you the greed involved in the life insurance industry. They do not want anybody to succeed when they can avoid it. Certainly, there's people that certainly buy life insurance and it performs as it's supposed to perform. But I sit here 31, 32 years in the business and see it every day where people have bought absolute garbage, runaway freight trains. They've paid more money in premiums than they will get in death benefit. They don't even know they've done it, and it's criminal to a degree. So the part that I always allude to as being criminal is the fact that you have an option to sell your policy. You go to your advisor. They don't know me. They don't even know you, but they know their life insurance agent, and he or she works for one of these firms that you're not allowed to talk to. They have about life settlements, and they're basically don't tell them that this option exists, and they surrender the policy or worse yet, let it lapse. And they could have sold it, and there's no repercussion for them. There's nothing they can do. I do think over time, as our industry continues to grow and people become more aware, you've got to see some more class actions related to that because it's just not right. I would be upset if I asked my advisor or my insurance agent, what are my options about a policy he or she sold me, and they told me no. So, not to confuse your audience, but the bottom line is, I'm frustrated that we don't do a good enough job. When you talk about term policies that don't go to claim, they're the number one case because when you think about graduating from college, going back to your younger audience listeners, they get insurance the second they get their first job. They leave that job, they get their second job, they get another insurance package, they get their third job, their fourth job. Each one of those steps along the way, they had insurance. And every step along the way, they let that policy more or less lapse. The other thing that takes it to the other end of the spectrum is when they're in a job, they've had insurance forever. Life insurance companies are supposed to let you know you can take that policy with you. It's portable. They don't. Some do. I'm not going to say that that's a one size fits all, but for the most part, they don't. They have no idea they could do it. And it's, they've paid in it for, in some case, 25, 30 years. And they have no idea that a policy is theirs. So we've got our work to do. Obviously, we're up against it, but I like our position now. I think we've got the winds at our back in terms of these arguments that we're hearing about, our industry and watch out are falling on deaf ears to those that are around to hear it. So again, being on shows like yours with your audience to talk about it is why I'm here.
Well, I just don't think people know that they have options. I mean, especially, and I hate to go into the senior market, but the senior market, like they certainly don't know they have these options. So a lot of times the only option they think they have, if they can't afford their premiums, is to let the policy lapse. And then obviously all those premiums they paid for all those years, it's gone. The death benefit's gone. And now their family is left with the burden of any final expenses that would happen, like funerals and burials. And that's the thing, I've delivered so many death benefits in my time, and I've spent just about 21 years in this industry now, so not as long as you, but long enough to have been around the block several times, delivering the death benefits. Every time I've delivered them, and just for the record, all of you know that like what I do is I teach the infinite banking concepts, and I teach people how to take back control of their money by being the bank. So with doing that, we use specially designed whole life. But what I'm trying to explain is we're using it for banking, but that seems to be the most important thing because that's what I teach and that's what people are using it for, but it's really not. When that person passes away, and we've had many clients pass away, and that insurance company gives us a check to deliver to that widow or that family member that just lost a loved one, I promise you that is the single most important transaction I will ever do in my life every time I get to do it. It is an honor to deliver a death benefit because you know that client that passed away did something amazing and provided a legacy for their family. But the problem with that one honor that I get is there are so many more that should have that happen. There are so many more death benefits that should be paid out that are not, because the people surrender the policies. They get in hard financial times. Listen, we're going into an economic slowdown right now, no question about it. And as we go into this economic slowdown, I will tell you the one thing I'm seeing is a higher and higher surrender rate, which means people are surrendering their policies because they just throw their arms up. They feel, all right, well, things got rough. My real estate ventures didn't go good. I don't have the money, so I'm just going to let this thing go. But Rob, they need to meet people like you, because maybe that isn't the end of the road. Maybe just throwing the policy away for nothing and letting the insurance company win isn't the final stop. You provide options. So let's just talk about that a little bit, about these options on how these people that like get in these hard financial times, they could literally sell this. It's an asset. It's just like you mentioned, like a piece of real estate. It is an asset. And you guys know that, but the client sometimes forgets that.
Well, to your point, so we're not quite as involved in their personal finances as you are, but we somehow become part of it towards the end. We're working with their advisor that bring us the policyholder. So when you talk about, all the different things that they can do, one of the things we've done is, talk about they're left with nothing. They surrender the policy, or they don't surrender. God forbid they let it lapse, and there's absolutely nothing. What we've been able to do is we've been able to work with some of the provider funds to work on what's called a retained death benefit. This is an interesting concept because it does exactly what it is we're trying to avoid, which is to leave them with nothing. So someone were to sell, we'll just make it up, a $500,000 policy. And they really don't need the insurance. They'd like insurance, but they really don't need it. They can't afford it. What are their options? So we can say we can split the policy in two. In some cases, that works. Now they're paying half the premium for half the death benefit. They're getting some cash to help offset that. But what's become more popular is retained death benefit option. What does that mean? So that says, okay, and you don't need cash, but you like life insurance. You don't necessarily want to pay for life insurance. What are my options? So we've been able to finesse something where they get like $5,000 in cash, and they name a beneficiary. And we place the beneficiary when we sell the policy to the buyer, recorded at the carrier level that they're on the carrier for 20% of the death benefit. So when they die, their beneficiary gets $100,000 of the $500,000. They don't make another premium payment ever. It's just part of that. It safeguards against what most people do, which is spend the money. Mm-hmm. So we give them the money, go, oh, I'm going to save that for my funeral. Well, funerals in 2025 are X, and in 2035 are Y. They're more expensive, and you've spent the money. You don't have that money. That $100,000 sets aside the fact that you're going to have plenty of money to bury mom, to bury dad, et cetera. And that's become increasingly popular for that exact reason. To your other point, it's yours. You own it like you own your home. So what am I going to do with something that I own? So I'm going to sell it. So what we've been able to do is we act as the broker. We're not a buyer. I don't buy any policies. I represent the seller. We go out to all the buyers they may have seen on TV and others, and all the funds behind them deploy their capital through these licensed entities. And I put them in front of everybody and just drive the price up as best I can based upon the available information. We collect their current medical records, and we want to know everything about the client's health. So we get those records that are attached. We get an in-force illustration. We kind of forecast the premiums. And that's really how the math and the offer is generated. How long will I have to pay this premium? And in order to do that, how much can I give the client? And then the client can make a decision whether what's best for them or not at that point in time. Generally speaking, I'm on the board of LISA, Life Insurance Settlement Association. We just finished our 4th data collection project where we study the statistics from the prior year. And once again, a consumer will receive 6.6 times more settlement value than they will surrender value in this life insurance policy. So that's significant. That doesn't mean
I didn't know it was that high, Rob. I did not know it was that high. 6.66
times.
We should go 6. Wow.
6.5. 6.5.
Yeah, we'll say 6.5. 6.5.
6.5. Well, it's over time. So we've had one, honestly, it's crazy. So we've had one that was 5.2 times one year, 6.2 times the other year, 7.8 times the other year, and this year was 6.6. So it averaged about 6.5 times. So I tell people, forget those numbers. Just pretend it's 3 times more. It's just 3. Would you rather surrender for 100 or sell for 300?
Sell for 3.
Exactly. So that's what we're trying to put in front of people. And again, they're in control. They don't have to sell. They can do whatever they want. Sometimes, Chris, and I just got off the call with you prior to this podcast, and the client got an offer that honestly exceeded my expectations. It was way higher than I thought they'd get. It was way higher than they thought they'd get. They're keeping the policy because to them, the policy became more valuable. They want to hold it. They don't even think, I don't even think they want to even sell it later. They just want to hold it because they feel like,
Well,
wow.
what a great thing. They finally realized the value of this asset, which they were literally willing to sell. And then because someone else is willing to pay them a lot more, they're like, wait a second, what do we have here?
No,
Right?
they may
That's
sell
so
it
great.
later, but they're sitting on it. And I think it almost like she said, it's kind of peace of mind, right? I got this under my pillow. I know it's here, and that's all I really need to know. And it was a significant number, close to seven figures that they were going to get. So but they also had the money to pay the premium. They just didn't want to pay it anymore. Now they want to pay it.
Mm-hmm.
So interesting.
That's a great story. I love that because I mean, we talk to hundreds and hundreds of people a month. You know, we set up hundreds of policies a month, and the people see the value in the beginning, but as time goes on and people get in their ear and they talk to the primary agent, who says, "Why do you have this stupid whole life policy? You should have term insurance. You're way overpaying," and they start buying into this bullshit. And then all of a sudden, what's the primary, agent going to tell them to do with the whole life? Just surrender it and just take the cash. Where they could call someone like you, even if that's the route they went, and they could at least get more for the whole life. And then the whole life stays in the books. Maybe they have a health concern or something. They can't get insurance. I recently, and I'm not going to give any names because I'd get myself a slap with a non-compete with this one, but there's an IUL agent out there running around literally just doing criminal activities. And I'm not going to use his name, but he's going out there and forcefully having people surrender active, good whole life policies, and he's surrendering them, then taking the cash and putting it into an IUL, generating a commission. Now, Rob, you know this industry long enough. Why would an agent ever tell someone to surrender and then take the surrender dollars and put them back in the policy?
Well, I'm going to guess there's a commission involved.
Well, that's number one. What's the most important reason why they wouldn't follow the normal Reg 60 protocol?
You're going to have to tell me. I'm not going to guess.
Well, the reason is because they would never get it approved. The insurance company that's selling the IUL would never, ever, ever, ever approve a replacement of a whole life policy at that stage. They wouldn't approve it. So therefore,
you didn't ask them questions like, where's this money coming from? None of that?
They should be. Listen, we can take both sides of the fence on the insurance companies, but usually they're not asking the right questions, and then they're blaming somebody else. They'll hang the agent before they ever take the fall when they should have been asking the questions right along. But that's it. And I've seen this happen. I've seen this happen 10 times in the last 3 months where they have surrendered these whole life policies, moved them into an IUL. And folks, listen, I'm not going to take a stance on IUL. You already know where I sit. But those policies with a rising cost of insurance, the majority of those policies will fail. And those policies will become worthless. People will surrender them. People will lapse them. They won't materialize. I've seen the numbers. I've seen how it happens, and I've seen it in the past with the target ULs. So the thing I'm trying to explain, and I kind of went down a rabbit hole there. Sorry about that.
It's a good rabbit hole.
Yeah, Rob. But, people are bypassing the rules, doing things that you can't say they're illegal, but they're definitely against the rules and have serious consequences for the agent just to generate commissions. And the person who's left holding the bag is the client. Almost always. If the client knew you and came to you for something like that and said, "Hey, I'm just going to surrender this thing. Would you buy this? Could you find a buyer for this?" And you went out there, then they might find out that thing has a lot more value than what that Primerica or other IUL agent told them it had, and they might start to rethink the decision they're going to make. I mean, just like you had mentioned, that's where that story came from. Is that person decided to keep the policy because, listen, if somebody's willing to pay me this much more for it, well, heck, what do we got here? Maybe we'll keep this under our pillow. Well, that probably could be the case for a lot of the hanky-panky going on in the industry. But no matter how you roll this. No matter how you look at this, it's a positive for the client. If the client doesn't want the policy anymore because they just don't want it, now they've got an exit where they can get more money. If the client can't afford the policy but really needs the death benefit, they could work a deal where you could basically, keep a retained death benefit, so the family doesn't have to wear the weight of all those final expenses. The money's there to like you said, bury mom and dad and provide a nice funeral and just a great time for the family. Where before, the family has to come together. I've seen this in my own family where my family members had to pool money together just to pay for the flowers in the funeral.
Sure.
Folks, please don't let that be you. It is a sad, sad, sad thing. And I've seen it firsthand, and it won't be the last time I see it. So, Rob, let's just talk a little bit more about that. And some of that story you just told me was great. What other good stories do you have of just clients that you've been able to help, and why were they getting rid of their policies?
Well, there's from A to Z. Honestly, there's every reason under the sun. Most of them is the reason that they bought it have subsided. So you take a typical family who buys a life insurance policy. They just got a new mortgage on a house. They just either just had children, were saving for college educations. Both are working, nannies, etc. So if something were to happen to one of them, this money would stave off that period of time necessary to get back on their feet. That's the most common reason. But I'll lead with this because you got me thinking about this. So where I got in the beginning. At the beginning of the game in the 90s, I was selling policies. We're selling 100 policies a week, if you can even imagine that, over time. And I had no time to even think about the insurance industry. I did. It wasn't until we got in life settlements and the policy face value went from 60,000 on average to 2.5 million. Then you got the insurance company's attention. And a word came up, and I'll tell you who said it. Alan Berger, who was the co-founder of Coventry, which is a huge company in our business, spoke to us at one of our first meetings in the life settlement industry. And he used the word monopsony as what insurance companies want to enjoy. That's their utopia, is they want to sell you the policy, and the only way out is back through them. They don't want there to be any other resource available. And that's when my mind started to think about, this is a much bigger project than I signed up for, and I'm happy to get involved. So they've been at it ever since, is to come up to confuse clients, to obfuscate. We talked about HIPAA was in response to the HIV and AIDS life settlement industry called radical settlements back then. So we knew we had their attention in the mid 90s, and then later on, as we moved through the 2000s, this industry started to really grow up in the sense that this was a mainstream financial planning tool. So why do people get rid of their policies? In the ultra high net worth regions, it's estate planning. Policies that they bought from their agent are not doing what it's supposed to do. They're blowing up left and right. Remember that old? There was the old saying of some of the life insurance policies that were just like disappearing premium. Remember that one?
Oh, yeah. Oh, gosh. Those are universal life vehicles.
Those were what we were selling left and right, because the policy did, in fact, a guy made this argument at a meeting I went to that they did, in fact, disappear. He, working on a spin, tried this out, this trial balloon. I said, they disappeared because we said they were going to be $1,700 a month, and now they're $4,200. So the 1,700 disappeared. And I said, no, that's not going to work. I mean, you do know that's not going to fly. But there's always been a mistake that the insurance industry makes. And then they point the fingers at us, that we somehow were involved, that we somehow came up with that. We had no idea that was happening. So vanishing and disappearing premium was all the rage in the mid 2000s in our industry.
I remember it. I was in the industry during that period of time. And I watched a whole bunch of those things fail. I physically was in front of these older, these older families, and I was telling them exactly what you just said. Hey, you set this policy up with $600 a month, but unfortunately now it's going to be $1,000 a month just to maintain the death benefit, and that doesn't even get you to age 100.
Right. And they did it, and it was quick. It wasn't like they had them for 12 years or 13 years. It was like, in year 4, oh yeah, we were just kidding about that $600. We meant to say $2,600. And so we've always been around to scoop up the trash, because someone will buy those policies because now they know what they're worth, but they'll give the client little or no money. little or no money for it. So when you think about why, I always tell people every deal is a snowflake. There's always difference. I've had guys, and this, I don't know if I told you this in the first episode, but one of my first larger clients calls me at 3 a.m. Now he's in California, so it's midnight. And he says he's got 12 or $13 million of life insurance. Now, this is back in the Vatican days, so we're thinking that's a huge policy. Well, he's got inoperable brain cancer. He's going to die. There's no doubt about it. We have his records. We've shown to everybody. He gets almost 82% of his death claim met to take that money. And you know what he used it for? He went overseas to a non-FDA approved clinic and cured himself. UCLA Medical Center could not believe this guy's alive. Okay, could not believe it. Came back, showed the records. They're all like in disbelief. The guy's completely healthy. 3 years later, he calls me up. He's HIV positive. And this is before 96. So he's like 96. He's calling me up. Now he's HIV positive. He lives long enough to sell more policies. He's able to get more policies and to take the protease inhibitors, and he lived. So he didn't even die from that. So he's now
This is one resilient guy.
Yeah. So hold on, it gets better. God rest his soul. He has since passed, but he then goes on the news because I know a friend that's talking to him. He's tracking his policies, and John's a great guy. So he goes to buy Corona beer, a case of Corona beer in the summer. And apparently there was a time where the thickness of the Corona beer bottle had some problems with the plant. So wouldn't expand and contract as it's supposed to with the heat variance of summer in Long Island. So cold in the store, hot in the car, back to the inside the house with a different temperature. Well, the whole thing exploded. Glass everywhere, all over his body. Sues Corona for a couple $1 million. He lives again, and then unfortunately he passed away. He was close to 80 years old. But that's an extreme example of what somebody does with their money, right? They do all kinds of things. He's cured himself, stayed alive long enough to get the protease inhibitors, and then went and had a treatment overseas and these are all true stories. This is not like I'm making it up. Other people, the best stories are the ones that take the money and they're close to the end of their life. They take all the money and they bring in their entire family. One was in Hilton Head, another was at Disney World, 40 different family members all flying, pays the way, hotels for a week while they're healthy, while they're cognizant of what's happening. And that's a memory that the family could take with them all life, with money from an asset that they were getting ready to throw in the garbage. So those are victories to me. All of them are because they always make someone happy. Even the folks that we don't sell, sometimes telling them that they're too healthy to sell is also good news. As I said, because if our industry thinks you're too healthy, you kind of are too healthy, and you're just going to live too long. And then they make the decision whether to keep the policy or not. Some do, and we see them a couple years later, and others let it go because it's just ridiculously expensive. So they're all over the place.
Well, I love some of those stories, and I've heard others that you've told. But sometimes when people get sick, especially life-threatening sicknesses or debilitating or Alzheimer's or anything else, it comes on quick. They can no longer work. They rely on fixed incomes, which aren't enough to support their standard of living. And they've got this life insurance policy, which they're not going to be able to afford, which obviously, if they can't make the premium payments, the policy is going to lapse. And that's usually what happens. The insurance company wins. Where you provide this alternative where you take it to your buyers and you shop it for the best price. And I can't believe that one. You said 82% of the death benefit was recovered.
That was in the 90s, and yes, the cost of capital wasn't as much. They weren't raising it into the investors. These were just large groups who were buying it. This happens to be a subsidiary of CNA Life Insurance.
Well, we'll just go with the 3 times. I know you said it was over about 6.5 times. Even in that case, you give somebody like that a check that they would have gotten nothing from it because they wouldn't have been able to maintain it. And then that person, in those final years, months, days, in some cases, now gets to go enjoy that, make memories with their family. There's no dollar amount that you could ever, put to a memory like that. And that's it. That's the final hurrah with that person's life. So your company and what you do enable people to do things like that. So I think, I understand why the life insurance company doesn't like your industry. And that's just because the life insurance company needs these policies to lapse, wants these policies to lapse, and they win.
Well, let me tell you what my thinking has been. It's been this way for a long time, but I'm starting to think of take the gloves off approach. Is the reality is I've always argued, and I've said this on many panels in front of life insurance CEOs, and I said, and they always talk about they're struggling to sell life insurance. They're always saying that, well, we're not selling enough life insurance. There was always one bucket they're not selling enough of. And I said, well, I think you would sell more life insurance in all the buckets if one of the reasons that you told someone when they bought life insurance that exists at the end, you talk about taking a loan from the policy, you talk about reducing the face, exchanging the policy. Those are all things that are discussed or should be discussed when you buy the policy initially. I think if you discuss the availability of a secondary marketplace to sell your policy to a third-party investor to get a multiple of your cash surrender value, or in the case of the term, any money, would be a reason that somebody would buy. I think that might be the reason that I would buy, because they're like, wait a minute, there's a market. Just like if you take that and you take life insurance and just put home ownership in the same place, that's the exact reason why people buy homes. That's the reason, because they can sell it, own it for 17 years, bought it for 400,000, now worth 1.2, sell it, it's your house. That's the reason they buy. If you couldn't sell your house to anybody other than the company, the person you bought it from, the monopsony, if you will, no one would buy a house. Well, somebody would, but not a lot of people. So we're trying to equate that. I mean, it was a Supreme Court decision in 1911 where someone put up their life insurance policy as collateral, and they fought it up to in 1911. I don't know how sophisticated that was to get the Supreme Court, but they ruled that it's the same property characteristics as home ownership. Same thing, it's yours. So I think and I say this to insurance companies to their face, I like life insurance. I think life insurance is wonderful. I own life insurance. You own life insurance. But the fact that there just seemed to me to be this never-ending greed that they just can't let somebody get an edge on them. I think if people sold their policy for a lot of money in large numbers, and that spread like wildfire, more people would buy life insurance. Makes sense. But that's kind of where we sit today. They just never, and I think part of it is the leadership at the heads of these life insurance companies, they're not there that long. There's no leadership guy that's been there for 25 years. Mm-hmm. He's there, he runs John Hancock, and he takes his golden parachute and leaves. And while they're there, they're all just trying to make as much premium as they can and pay as little death claims as they can and drive their profits up. Shareholders are happy, dividends are thrown around. That's what the scary part is. And I think if we got to a point where we could educate them to help educate consumers, they would sell more life insurance, we would do more life settlements, and the circle would grow. My thoughts.
Yeah, I think you're absolutely right. And you are absolutely correct. The life insurance companies are always saying, oh, we need to sell more life insurance. I mean, gosh, we don't have time on this podcast to go over all the reasons, but the life insurance industry is such an antiquated sales model to get go. I take my new org back in the early 2000s when I started in this, there was a room of 25 brand new agents just starting in training. By the end of the first year, that was in half. So there was only half of us left. And then by the start of the third year, I was the only one left. So you went from a room of, let's say, 25 people down to one. That's it. Because it's such a hard industry to make it. So when they talk about having a hard time selling, it's because they can't keep people because they're just not, it's antiquated. And plus, the products they're designing are in some cases designed to fail. People are leery of that. And there's no exit, right? People think the only exit is give it back to the insurance company. And, in most cases, people don't make any money that way. So I think having that exit strategy for people would give them a lot more confidence to buy it, hold it, and if things went south, they have an option.
Great. Yeah. I mean, that's the thing about life insurance companies that I've noticed, and this is just me talking now, my limited experience with them, except for what I do here, is their sales to get the policy issued, even though it's antiquated, is is still operating in the vicinity of 2025. If you need something,
What do you mean by 12?
they have systems in place where they're emailing you forms and they're scanning
right.
forms back, and you can do all that. Anything to get the policy in force, today's technology. But if you need something from them, it's 1975. It's faxes, it's regular mail. They can't even email you anything. They have to fax it to you. We have e-faxes on our computer so we can deal with insurance companies. And I think that's laughable, when they claim about they're not making enough money, and you look at their profits, what they do. It blows my mind. There was a woman during COVID who we're calling her, and we're helping out to try and get this stuff. It was very difficult. And she said, "Oh, I just got back from the office." And I said, "You got back from the office? What do you mean?" She goes, "Oh, I went to the office. I go every other week, and Sharon goes the other 2 weeks." I go, "For what?" She goes, "We pick up the faxes." I go, "You pick up the faxes?" She goes, "Yeah, I got all the faxes together. So these faxes are going into a building in Indiana that no one's in. So that's security. And they're dropping them on the floor. She's putting them together, and they're taking them out, wheeling them to her car, bringing them to her house. You know what she does? Scans them and emails them to the appropriate person from her house." And I said, "Wouldn't it have been easier if they just emailed the person they needed to go to from their own computer?" And she goes, "Yeah, that would be nice. That's never happening." That's what she said. And this is going on during COVID. And I felt so bad for the woman. She turned around. She said, "I'll look through the faxes and try and find yours and put it at the top." And she did. But I mean, that's crazy. That's crazy. So we're always talking about the New York cybersecurity, and we got to have this, and this has to be uploaded and it has to be encrypted. So we take the meds as we get them in, Chris, and they come in, and we take the meds and we scan them in, and they're uploaded, and the people that through a licensing matrix who can get them, they're sent out. There's an invitation. They can go in and look at them, and it's secure. But the problem is the medical records that we get either are faxed to us, which I can tell you is not secure, and even less secure, they're mailed to us in regular mail. They cut out the sides of the manila folder to make it thicker. I mean, so they could put more weight in, then they tape it and they send it to us in the regular mail. We all know that the U.S. Postal Service never loses any mail. These are the people's medical records. And I try and explain that to the regulators, like, okay, we're complying with the New York cybersecurity, but is John Hancock? Because I don't think so. And they get away with it. They don't care. They're actually, you term like too big to fail.
Yeah.
They're too big to do anything to. They don't listen to anybody. TARP money, they didn't get any. They didn't need it. It's just
that is an interesting thing. The insurance industry definitely did not need TARP funds.
Nope.
I remember that.
Yeah, not a dollar.
No,
they buy real estate. Now, I learned at one of the conferences I went to in Bermuda that all of the insurance companies, a guy that I probably should have told me this in the setting we were at, that they buy real estate. All of them. You go in any city, you fly in, and you look out the buildings. They don't say their names. They just own them. Someone else leases from them. That's what they do with their money. So they also buy all reinsurance over there. So they're claiming, oh, they're at risk. They're not at risk. They're paying a fee over there for stuff that never really has to happen. They've got a business model where 9 out of 10 deals never go to claim or more. So I'm trying to figure out how we can go get along, because I think we're not here to, if I said, oh, I hate life insurance, let's get rid of it, then I'd be out of business too. The answer is, I think we need to coexist. Now, we're too tiny to really push that on them, but I think some of the governing bodies out there that have no problem regulating me for nonsensical nonsense, if you will, could be like saying to them, like, look, you got to come into play here. You can't be just copying medical records and putting them in a manila envelope, putting them in the mail. How's that secure?
It's not.
Can't. It's not secure.
Wow. So, Rob, how would people go about getting a hold of you if they wanted to have a discussion about what they could do with their policy?
They can call me on my cell phone, 954-599-4433, or they can email me at rob@live, settlements, settlements.com.
Awesome. So folks, in the description, if you didn't catch that, you should just rewind it and listen to it again. But we'll put that phone number in the description of this podcast so that you can get a hold of Rob, start talking to him about, listen, all different things. I mean, whatever it is you're trying to accomplish, have a discussion, see if it works for you. And if it does, great. If it doesn't, you will have learned something. Rob's a wealth of knowledge, as you can tell, doing this a long time. So, I'm sure the stories could go on for hours. But
Probably.
the most important story, folks, is your story. And that's the story you're writing. And that's the story you need to complete. So let's start there. Rob, thanks so much for coming on the podcast again. This is always fun. It's just interesting to hear about the industry. I've known about it for a long time, but I love hearing deeper about, what you're doing, how you're doing it, and the stories never get old.
Well, thank you, Chris. It's an awesome platform, and you've got a tremendous following. Of all the podcasts I've done, this is the one I've received the most activity from, for certain.
That's fantastic. Well, thanks, folks, for listening to this episode. Thank you, Rob, for coming on. And again, I'll put that number up, Rob, one more time. Shoot your phone number.
954-599-4433.
All right, folks, we'll put that in the description. And we'll see you on the next episode of the Money School podcast. Till then, go out there, take back control of your money, and learn how to be your own bank. See you then.